old money, new money. You've got your traditional bank, and you've got those slick new payment apps right on your phone. Are they just two sides of the same coin? Today, we're going to follow the money and see if old school banks and new tech really have the same kind of impact on an economy.
I mean, think about it. You use them for everything, right? Saving, spending, maybe even borrowing. But have you ever stopped to wonder what happens to that money after you tap your screen or swipe your card? Where does it actually go? Does it all end up fueling the same parts of our economy? Well, that is the big mystery we're diving into today. So, first up, old banks versus new tech. To really get to the bottom of this, we're looking at a fascinating study out of Indonesia. I mean, it's one of the most dynamic financial landscapes on the planet right now. Researchers there decided to play detective. They followed the money from old school banks and new fintech companies to see, where do the loans really go? Okay, so let's meet the lenders. We've got three main characters in our financial detective story, and each one plays the game a little differently. First up, you've got what we'll call the local hero, the rural banks. Now, these are your small, community-focused banks. They're not using some fancy algorithm. Their whole model is based on knowing their customers face-to-face. It's called relationship lending, and it's all about trust and knowing the local scene. Then, of course, you've got the big city giant. These are the commercial banks we're all familiar with. Their game is transactional lending. It is all about the hard data, right? Your credit score, what you own, your financial history, the whole shebang. It's super efficient, yeah, but it definitely helps if you've already got that paper trail. And rounding out our trio is the new disruptor, fintech, specifically peer-to-peer lending. We're talking about those digital platforms right on your phone. They use what's called algorithmic lending. They just crunch enormous amounts of data, sometimes stuff that isn't even about finance, to figure out who's a good bet for a loan. This means they can often reach people the big banks might just overlook. All right, so now that we've met our lenders, let's get down to business. Question number one, who's actually funding the real engine of the economy? The small businesses that create the vast majority of jobs. And you really can't overstate how important this is. Just look at this number from Indonesia, 97%. That's the percentage of the entire national workforce employed by these small and medium businesses. They are quite literally the backbone of the economy. So the question remains, who is funding them? And boom, here's our first major clue from the study. When you look at the impact on actual business production, what do you see? Both rural banks and commercial banks, a big positive impact. But then you look at fintech, and nothing, no significant effect. Kind of surprising, right? So the takeaway here is pretty crystal clear. It's the traditional banks, the old money from our local heroes and city giants that are really funding business production. And that just makes the mystery even deeper. If all that fintech money isn't going to businesses, then where in the world is it going? Which naturally brings us to the other side of the coin. If it's not production, maybe it's consumption. Let's ask, who's fueling our spending? And this is where the plot really thickens. The results are a complete flip-flop. The study found that loans from traditional banks, no real effect on consumer spending. But fintech, bingo, a clear positive effect. It's the total opposite of what we saw with businesses. So there it is, mystery solved. That new money from all those fintech apps is being used to buy stuff. It's boosting household purchasing power and directly pouring fuel on the consumer spending fire. Okay, so we have our two big clues. We know where the money is going. Let's put the puzzle together. Turns out, banks and fintech are not doing the same thing. Not at all. They are on two totally different paths to growing the economy. And this little quote from the study is really the key to understanding the whole thing. It says, the impact on what's called GRDP, that's just a fancy term for a region's total economic output. It doesn't happen directly. Instead, the money's impact flows indirectly. It has to go through one of two channels, either business production or consumer spending. And here's what that looks like. Think of it like a highway with two separate lanes. In lane one, you've got traditional banks. They fund small businesses, that boosts production, and boom, the economy grows. Meanwhile, over in lane two, you've got fintech. They fund our shopping sprees. That boosts consumer spending, and guess what? The economy also grows. Two totally separate paths leading to the same destination. Now, this is the real aha moment of the whole study. The researchers actually looked for a direct link. Does a loan just magically make the economy grow? And the answer was no, they didn't find one. The impact is entirely indirect. It has to go through one of those two lanes, production or consumption. So, what does this all mean? We've got two different financial tools doing two completely different jobs. Why does this matter in the real world? Why should anyone, from policymakers to us, actually care?
Well, for starters, it means you need a balanced strategy. The study basically says, hey, let the traditional banks do what they're good at, funding productive businesses. But at the same time, let's guide fintech to make all that consumer lending safer and more inclusive. That means stronger protections for people taking out digital loans, and maybe, just maybe, encourage these two worlds to actually work together. Look, the big takeaway here is this. Your bank and your payment app are not interchangeable. They're not enemies, but they're not the same thing either. They are specialized tools. Think of one as a hammer, perfect for building businesses, and the other as a key, great for unlocking consumer spending. A healthy economy, it absolutely needs both. And that leaves us with one last thing to chew on. As technology keeps blurring the lines and you see big banks trying to act more like tech companies, what's going to happen? Will these two lanes eventually just merge into one giant financial superhighway, or will they become even more specialized, each doubling down on what it does best? That's the big question for the future.